The crypto market just sent a shockwave through investors worldwide, wiping billions from portfolios in hours and leaving traders staring at red charts, wondering if the next move will be recovery or another brutal plunge. Over the past few days, Bitcoin has shown exactly why it remains the most emotionally volatile asset on the planet. After pushing toward the $70,000 level and igniting fresh optimism, the world's largest cryptocurrency abruptly reversed course, slipping back below key support zones and shaking market confidence. The drop didn't happen in isolation. Ethereum followed with deeper percentage losses, and XRP joined the slide, reinforcing a broader risk-off sentiment across digital assets. Market analysts point to a mix of macroeconomic pressure and profit-taking as the primary triggers. With upcoming U.S. economic data and interest rate expectations looming, institutional investors appear cautious, reducing exposure to risk assets. Crypto markets, which had rallied aggressively earlier, became vulnerable to rapid deleveraging once momentum stalled. Recent volatility has been extreme even by crypto standards. Bitcoin briefly flirted with the $60,000 zone during the recent sell-off, marking one of the sharpest pullbacks in years. That level has now become psychologically critical. Traders are watching the 60K-74K range as the defining battlefield for the next major trend. If Bitcoin can reclaim the upper range, bullish momentum could return quickly. Failure to do so could open the door to deeper corrections. Trading volume has also contracted, a signal that market participation is thinning during uncertainty. Lower liquidity often amplifies price swings, meaning sudden spikes or drops may continue in the near term. For short-term traders, this environment offers opportunity, but also extreme risk. Beyond price action, global regulation is once again stepping into the spotlight. European policymakers are considering a proposal that would ban cryptocurrency transactions linked to Russia. The aim is to prevent digital assets from being used to bypass international sanctions. If implemented, such restrictions could reshape how cross-border crypto transfers are monitored and enforced. This potential move reflects a broader global trend. Governments are tightening oversight of digital finance. While crypto was once celebrated for its borderless freedom, increasing regulation suggests that the industry is entering a new era, one defined by compliance, surveillance, and institutional integration. Adding to regulatory pressure are growing concerns about illicit crypto activity. Recent reports highlight a sharp rise in criminal networks using digital currencies to facilitate trafficking and other illegal operations. Stablecoins and encrypted messaging platforms have reportedly become preferred tools for these transactions, allowing actors to move funds quickly and across jurisdictions. This surge in misuse does not define the crypto industry, but it does fuel political urgency for stricter oversight. Regulators worldwide are likely to use such reports to justify expanded monitoring requirements, tighter exchange controls, and stronger identity verification measures. Meanwhile, an unexpected transformation is unfolding inside the crypto mining sector. Several mining companies are pivoting toward artificial intelligence infrastructure, repurposing their high-performance computing power to support AI data centers. With demand for AI processing exploding, mining firms see an opportunity to stabilize revenue streams and reduce dependence on volatile crypto prices. Major financial analysts suggest that this shift could significantly increase the valuation of mining firms positioned to serve AI workloads. This convergence of crypto infrastructure and artificial intelligence represents a new phase in the digital economy, where computing power becomes the most valuable commodity. For investors, this evolution raises important questions. Crypto is no longer just about coins and tokens. It is about infrastructure, energy, computing, and the backbone of future technologies. The companies that adapt may thrive regardless of Bitcoin's price fluctuations. Back in the markets, sentiment remains fragile. Fear and greed indicators show hesitation rather than panic, suggesting investors are waiting for confirmation before committing capital. Some traders view the pullback as a healthy correction within a long-term bull cycle. Others warn that failure to regain momentum could signal a broader shift toward a bearish phase. Technical analysts emphasize the importance of reclaiming resistance levels near the low $70,000. A sustained move above that zone could trigger renewed buying pressure and liquidate short positions, accelerating upside momentum. Conversely, losing support near $60,000 could trigger cascading liquidations and intensify selling pressure. Macroeconomic forces continue to loom over crypto markets. Inflation trends, Federal Reserve policy signals, and global liquidity conditions remain key drivers of risk appetite. When liquidity tightens, speculative assets tend to suffer first. When liquidity expands, crypto often rallies with explosive speed. Institutional involvement adds another layer of complexity. Unlike earlier market cycles dominated by retail traders, today's crypto landscape includes hedge funds, asset managers, and publicly traded companies. Their strategies often involve risk hedging and algorithmic trading, which can accelerate volatility when key levels break. At the same time, long-term adoption continues to grow beneath the surface. Blockchain technology is being integrated into finance, supply chains, gaming, and digital identity systems. Major corporations continue exploring tokenization and decentralized infrastructure, suggesting that innovation is progressing regardless of short-term price swings. For everyday investors, the current environment demands discipline and perspective. Volatility is not a flaw in crypto markets, it is a defining characteristic. Rapid price swings create opportunity, but they also punish emotional decision-making. Experienced traders focus on risk management, position sizing, and strategic patience rather than reacting to every price movement. As the market searches for direction, one truth remains clear: crypto thrives on uncertainty, innovation, and disruption. Price crashes shake confidence, regulatory threats create fear, and technological shifts redefine the industry's future. Yet each cycle reshapes the ecosystem, pushing it toward maturity and broader adoption. The coming weeks may determine whether Bitcoin stabilizes and resumes its climb, or enters a deeper corrective phase. Traders are watching key price levels, policymakers are drafting new rules, and technology companies are transforming infrastructure to support the next wave of computing demand. Right now, the crypto market stands at a crossroads, caught between volatility and growth, regulation and freedom, risk and opportunity. And as history has shown time and time again, the next major move often arrives when the majority least expects it.